Welcome to the Guaranteed Retirement Guy Show. My name's John Stevenson, and I want to talk to you about how to maximize your return from a fixed index annuity. So fixed index annuities can have significant returns. Now, sometimes return is not as high as maybe you might get in the stock market, but then sometimes it is. It just depends on the index, depends on the year, depends on the participation rate, whether or not you have a cap on your growth. So there's a lot that goes into it. You have to think about how the insurance company is actually doing it really to understand it. So what insurance companies are doing, like for instance, if you are having, let's say you have an annuity contract and you have an index, let's say it's the S&P index, and the insurance company is saying, we're going to give you a 6% cap, and we're going to reset that cap every year. Okay, well, if that's capped at 6%, you know that if the market does 8, you're still only going to get 6. Okay, participation rate's a little different. Participation rates don't have a cap, they just have a participation rate in the index. So if the index does 12% and the participation rate is 100%, then you're going to get 12%. Okay? If the index does 20% and you've got a 50% participation rate, then you're only going to get 10%. Now, on the other hand, sometimes participation rates are quite high. You might have a participation rate that's 500%, which means if the index does 10%, you're going to earn 50%. That's pretty good. Now, a lot of times what advisors will do is they will show you these huge, outrageous returns for 20 years. The problem is most of the indexes will reset after 1 year, sometimes 2, sometimes 3 years. There are ones that actually last longer, but usually don't have as high of a participation rate. So it really just depends on the insurance company, how they're able to purchase the options as far as what price they're able to get options at. So if they're buying options associated with an index and they get a super cheap price, then they're able to give you a lot more growth. Now, at the same time, if the market is just going crazy, maybe interest rates are fluctuating in a way where the cost for the option is very, very expensive, then they can really purchase only so many options with that same budget every year, which means you're going to get less growth, and that is why they will change the participation rate. They will reset it at the end of each period. So the participation rate might change from 100% to 70% or 100% to 150%. It just depends. The same with the cap rates. I'm going to show you some opportunities that are out there. So, and obviously this is just as of the recording of this video, but if you're looking for just maximum growth for an annuity and you want market protection, but you want maximum growth, and maybe you don't want to be in the stock market, but at the same time you don't want to miss out, then you're going to love what I have to show you today. I'm sharing my screen and I wanted to show you some of the different indexes that are available. And these are all over the place. I mean, you got some B-rated companies, you got some A-rated companies, but it'll just kind of give you an idea. So you can see these top ones. This is a 3-year Credit Suisse, which just means that if the index, let's say you purchase an annuity right now, okay, and the index is measured over a 3-year period. What if it goes really, really hard, up 2 years, and you're up 30%? That's pretty good. But remember, it's a 3-year index, which means at the end of 3 years is when they credit it. What if that same index goes all the way down to to where it started in the beginning at the end of the 3-year period? Now, during that 3 years, you earned 0. Okay, so sometimes it's nice to have a 1-year index that's crediting your account every single year, so that if you do have a growth year, you get it. And maybe if you have those 2 years where it's earning 10% and then 15%, you get that credited to your account. And then if the second year the market goes down, you don't make anything, but you don't lose anything either. So that's kind of nice as far as being able to measure smaller periods of time, as far as the index is concerned. When we pick indexes and when I put these indexes together, usually I'll do a 1 year that will reset every 1 year. But you can also diversify, and you can do some 1 year, you can do 2 year, 3 years. So it just depends. So that's whenever you see a 3-year, or you see a 3-year, you see a 2-year down here, and so there's a lot of different periods, and there's a lot of 1 year too. You see 1 year, There's a lot of 2 years and 1 year. So a lot of the 2 years are just showing up on top right now because the last 2 years have been some very good growth years. And so this is just showing the top growth ones. Now, what I would recommend is if you're going to put it in an index where the index is being measured for a year and you want to have whatever growth the index has during that year, but at the same time you're worried about maybe having your participation rate changed too quickly, because usually, at the end of each point-to-point period, so if it's a 1 year point-to-point, then the end of that point-to-point is when they get to reset the par rates or participation rates, as well as any cap rates. If that particular index has a cap versus a participation rate. Now, sometimes it has spreads too. And sometimes they'll have a combination of that. So if it has a par rate of 100% but a spread of 1%, then if the index does 10%, you're going to get all 10% minus the spread, which is really you're going to net 9%. There are some indexes that don't have participation rates, they don't have caps, and they just have spreads. So you earn whatever the index earns. If the index earns 20% and the spread is 0.75, then you're going to earn 19.25%. Okay, so that's how those work. So sometimes there is a combination, sometimes there isn't. And you can see on my screen, you've got participation rates, some as high as 550%. Here's what I do like about this. You'll notice there is a 10-year lock-in period. That means that participation rate, it's locked in for 10 years at 550%. That's pretty good. Now, of course, this index it's only measuring the index over a 3-year period. So if you're looking for maybe a 1-year index, that might not be the right one. So there is another company, and I just wanted to show that to you real quick. Right now, as of this recording, Mass Mutual is actually giving you, and they're A++, so pretty good. They're giving you a 1 year point-to-point, so they could change that cap every year, but right now they're giving you a 12.5. Well, that's pretty good. And so if I look down here, it says, well, you know what, 12.5, yeah, that might be great this year, but what's going to happen next year? What if what if the options are really, really expensive? And what if they lower my cap to 7%? Well, I don't want that. And so you notice I'll look down the list, and this is showing a pretty decent 10-year, 15, and 20-year growth rate. That's not bad. But if I want to kind of lock that in a little bit longer as far as the cap, then I might look down here, and you'll see there is one for a 7-year lock-in. So it's still a 1 year point-to-point. So every single year it's going to measure whatever the index did, and it's going to credit your account up to the 10% cap. And they will not change that cap for at least 7 years because it's 7 years lock-in. So if we have a great 7 years, you're going to earn a lot of money with this. And if one of those 7 years the market just drops and we have a really tough correction, then at least during that year your account would just get a zero growth, but zero losses as well. So that's pretty nice. So this is kind of how you would maximize your returns when you're wanting to get as much growth as you possibly can out of your fixed index annuity. You want to pick companies that are good companies, and at the same time make sure those companies have some decent participation rates, make sure they're high enough where you can get some decent growth, and also cap rates. And then at the same time, if they allow a lock-in, if there is one that sometimes they don't have them available, but right now we're seeing a lot of them where they do lock in that participation rate or that cap for so many years, which is pretty nice. What I would do if I was worried about the participation rates or cap rates changing, then what I would do is I would just get one of these where it's locked in for 7 years, and at least I know that they're not going to limit it. They're going to limit it at 10%, but they're not going to ever go down during those 7 years. And then at the end of the 7 years, if they change it, you can always move it over to another product and continue that growth. So that's pretty cool. I do like being able to get as much growth as I can, but also protecting my money against market risk. Okay, so real quick on the maximizing returns for annuities. I can't talk about this without talking about income real quick. When people call me and they ask, how can I get the maximum income return for my annuity? They'll say, I'm 60 years old. Is it too late? Shouldn't I have bought this when I was 50? Well, most people that actually reach out to me are in their 60s. So it's pretty commonplace for people to purchase annuities in their 60s. And a lot of annuities, you don't want to purchase it too early. You want to make sure that you get some good rates at the right time. Sometimes you purchase it too early when the rates are not great. And right now rates are really, really good. And so people that are purchasing annuities are doing very, very well for lifetime income and, of course, growth as well. So what I did is I put someone who is 60 years old here on the screen. And then I put a spouse at 60 years old as well. So that'll affect it as well because I want joint income. Of course, if you're single, then the income's going to be higher. But just on this example, I'm putting $500,000 in, and then you'll notice I'm deferring joint income for 0 years, which means I'm taking it immediately. And so the highest one right now is Midland. So $34,675 per year for the rest of my life. And then these are all the rest of the other companies. Okay, and if I want to break that down monthly, then that's $2,890 per month starting next month. That's going to be deposited in my account for the rest of my life and the rest of my wife's life, especially if I die and she continues to live for 10, 15, 20 years, she continues to get that money. If you want to maximize it. So a lot of times if you want to have more income, but you want to have the same amount of money going into an annuity. Obviously, if we put more money into this immediate annuity, you can get more income immediately. But if you want to use less money for more income later, then buying an annuity earlier is better. And that's why when people ask me if it's too late, generally it's not too late. You can still get some great annuity payouts, regardless if it's immediate or deferred. Just remember, when it's deferred, when you do it earlier, you do have a growth rate, an internal growth rate that will give you a lot more guaranteed income. And that's called the income value that grows. And a lot of times they'll grow that with the roll-up rate. So I'll show that real quick. So if I were to say, all right, you know what, I'm 60, but we're not going to retire until we're 65 because Medicare won't start for us until then, and I don't want to pay any premiums for quitting my job right now and paying extra health insurance during that time. I don't want to cover that. So I'm going to purchase an annuity now, but I'm going to defer taking the income until I'm 65. Okay, so I'm going to stretch this out to 65. And so now me and my wife are both 65, and now I'm activating income. And so this will show me quite a few different policies. It shows, you notice there are some ones on the top where they'll give you a lot of income in the beginning, and then it drops it off sharply, which I don't usually recommend those. So I'm going to say a guaranteed amount that will never decrease starting at age 65. All right, so now this is monthly income, but you'll notice that AIG or Corbridge, Aspida, and North American are the top ones. And so that's pretty good. So we're seeing a lot of income, a lot more income than before. In fact, if you want to change that to annual, we're talking like 51,000. So you're getting almost 20,000 more in income just by waiting 5 years. So when you're thinking about maximizing the return on the income of your annuity, these can be very, very lucrative. You might be wondering how this works. I'll just go in here and I'll show you real quick what the growth looks like. And they show you two things. They'll show you the guaranteed side, which, they're showing you an extreme side. If the index does nothing, then of course your account value will go down. But that's very, very extreme because that's just considering no growth whatsoever. Now, if you look at the income base, though, that does grow. And you'll notice that grows substantially, almost at a 10% growth rate. I think this one's 9%. But you'll notice every single year that rate gets applied until the end of 5 years. No matter what your account balance is, they're still going to use $712,000 multiplied by 7.15 and give you $50,944 per year the rest of your life. And then the other scenario, they show you these huge rates of growth, show you your account value going up over here, and of course the income base still grows at the same rate, still gives you that same income. But these are showing 20% returns, 19% returns. That's too high to illustrate. So typically when I will illustrate these, I will illustrate them lower because this one in particular does not have any type of lock-in time for the rates. So the participation rate in this index can go down in 1 year. And this illustration is showing it never going down, which is never what I want to illustrate on some of these that doesn't have that lock-in. So anyways, yeah, the par rate on this is 155%. So that's why you see that growth. AIG, though, is not bad. They have some pretty decent growth rates. You just have to think to yourself, what do I want my money to do for me? If it's for living, then there's nothing wrong with getting an income annuity and not worrying so much about the growth of the account, but more worrying about how much income can you get from your money. Because isn't that why we save for retirement? We usually do it because we want income, and we want as much income as we can. And so it just really depends on your goals, but I wanted to show you how to maximize a return in your fixed index annuity if you're just looking for growth. no income rider. You're just looking for growth and maybe turn that into income later on. You can certainly do that. So that's what we talked about in the beginning. For the second portion of this, I just wanted to show you what that money could do as far as give you income. So if you have questions, if you want to go over this more in detail for yourself, whatever your goals are, I'd be happy to go over them with you. You'll notice that there is a link below this video. You can get into my calendar and we can go over your specific retirement strategy and growth strategy, and just, if you have an income strategy, we can look at that as well, and happy to answer your questions. So anyways, hope you enjoyed the video and look forward to seeing you in the next one.